The purpose of the Global CFO Council is to provide an educational and networking forum for senior financial executives in order to share best practices, discuss current financial issues, and to learn about current topics related to the performance of their jobs. Membership is open to senior financial executives including CFOs, financial VPs, and treasurers. We hope that you'll become a member of the Global CFO Council today. To join, please visit the membership tab at globalcfocouncil.com.
So Eric is a director at Pinnacle, focusing on their capital markets. I think you're based out of Knoxville, Tennessee. Got your undergrad in business administration from University of Tennessee, Knoxville. I think you are a CFA. And something interesting that I found out about you is I think right out of college, you taught English in Vietnam.
I did. That is correct.
Very cool. All right. I'm one for one. Sometimes I'm wrong. Sometimes I find out interesting stuff that's not true. So this is good. Christina is a vice presidente at Pinnacle. I think you're based out of the bachelorette capital of the world, Nashville, Tennessee. Got your undergraduate in Espanol from the University of the South, MBA from UT, and a JD from UT. And something interesting I found out about you is you got really good grades. I'm not going to share your grades because your grades were better than mine, but definitely Dean's List, very impressive, well done. And Brad, you know that it's you that I have pictures of if I haven't shared a picture yet. So that's coming. And I actually have a lot of choices, which is really fun, but I'm just going to pick one. Brad is a senior vice presidente at Pinnacle. I think you're based out of Greer, South Kakalaka. You have an interesting background of both banking, extensive banking, but also CFO, which is really awesome. And got your undergraduate from Sanford in business administration and a master's degree in accounting from Sanford. You have super interesting things I found online. It looks like you were a U.S. Senate page. You played tennis in high school. You used to do restaurant reviews, which is really fun. I think you lost your mind and decided to run for politics. I don't know what was going on with that. That was a lapse in judgment. And not only are you handsome now, you were very handsome in high school. Look at that hair. I've never had hair that good.
It's a head full of hair.
Wow. You live in the dream. And we're living the dream today that we get to have this amazing time and presentation. I am super excited about this presentation. This was a very hot topic, M&A activity, ESOPs, getting a little taste of that. So I'm going to yield the floor. I'm going to make Christina the host again and just mute myself. And I'm super excited to be here. And I'll hit you up with some questions at halftime, and I'll hit you up with some questions at the end.
Well, thank you, Robert. Yes, we are excited to be here today. Appreciate all that background information. One day, Robert, I want someone to do some background information on you and show some old pictures of you. I think that would be fun for all of us. But before we bring in Eric and Christina, just a quick snapshot of who Pinnacle is. I promise this is not a sales pitch, but just in case you're not familiar with who we are, where we're located, I wanted you to at least have the opportunity to see this slide. We are headquartered out of Nashville, Tennessee, but as you can see, we've got coverage throughout the Southeast. Most recently, we just planted a flag down in Jacksonville, Florida earlier this year, so we're real excited about that. We are hanging out right around 50 billion-ish in assets, so that makes us considered a larger regional bank, I suppose. Now, we would certainly welcome the opportunity. Today's not this day, but we would certainly welcome the opportunity to share more about our firm and a little bit more about our philosophy on banking. But I am not the star of the show, so I'm going to get out of the way and yield this presentation to both Eric and Christina with our capital markets group. So y'all take it away.
Excellent. Thank you, Brad. Appreciate it. Good morning, everyone. As Robert and Brad said, my name is Eric Wallace. I'm a managing director with the capital markets group here at Pinnacle. Obviously, also have Christina, really the brains behind the whole operation, on the call today as well. She's going to carry us home on the second half. But very happy to be joining everyone. Hope everyone's doing well. I think and hope we've come with a few interesting topics that will hopefully be informative, generate some good thought, dialogue, and questions. I think probably a good place to start is just a very quick background on who Christina and I are and what we do kind of day to day. As Robert mentioned, I joined Pinnacle back in 2015 when we first got our capital markets group formed. So I've been with the firm for about 9.5 years now and have kind of grown, started out as an associate and have grown with the group as we've kind of evolved over the last 10 years. What we primarily do, we work with middle market clients and prospects across a variety of industries and sizes, really advising them, the owners and the management team around succession and exit planning, helping them run sell-side and buy-side processes. We also help them raise capital outside of traditional bank financing, and then also do a good amount of just general advisory and consulting work and strategic planning work for clients. Prior to joining Pinnacle, I spent about 5 or 6 years in the securities industry, did a few things before that, as Robert said, taught English abroad for a brief stint after school, which was really fun, before I wanted to join the quote real world. But love what we do, love getting to interact with business owners and management teams. Very gratifying to really help them with one of the most important decisions that they'll ever make when they decide that they're going to sell their business. And it's a responsibility we don't take lightly. That's a quick background on me. I'll toss it over to Christina briefly to give you her background.
Yeah, thanks, Eric. I'm Christina Maradian. I've been with Pinnacle for about 3 years now. I sit in our Nashville office. I primarily work on M&A transactions, sell-side M&A transactions. I'm also a licensed Tennessee attorney, and so prior to working in investment banking, my practice area was employment law. So happy to be here. Thanks.
Excellent. So just kind of quickly, again, Christina and I sit within our investment banking group, also under the capital markets umbrella, just so everyone's aware. We have a loan syndication team that's headed up by some really quality folks, some of the best in the business that run that department. Also have a derivatives team that helps out bank clients, mainly with interest rate hedging through interest rate swaps, caps, collars. And then we also have a valuations team that does certified valuations for bank HLT transactions, ESOPs, estate planning, divorces, things of that nature. So there's about 10 people on our team that sit across Nashville and Knoxville, and we're excited. I think we've built out a really good team and are excited about the future. Enough about our group. I think, like I said, we've come with a few topics. I really want to give an update on kind of the M&A and lending marketplace, some trends and takeaways within the broader scope, and then kind of dive a little bit more into the lower middle market where Christina and I primarily operate, and I think a lot of people on this call probably do as well. And then on the second half, Christina is going to touch on capital structure, capital raises and alternatives, and kind of hit on ESOPs high level as well. I think it probably makes sense to kind of first take a step back, and this may be not informative or revelationary to anybody, but if you take a step back and look at the overall M&A landscape over the last 24, 36 months, you know, global and domestic really M&A activity peaked back in 2021, really both in terms of number of deals and deal value. And we'll probably never see those numbers as far as either of those go, probably ever again in our lifetimes. It was, you know, a lot driven by pent-up COVID demand. We were in a historically low interest rate environment, and a lot of things were really driving that. But the numbers were outrageous. So it's kind of, you can't really compare apples to apples today versus 2021 when we were at the peak. But since then, activity, you know, across the board has really slowed and steadily declined. We hit a trough pretty much in Q3 of 2023, you know, primarily driven by rising interest rate environment after the Silicon Valley Bank, macroeconomic uncertainty, a lot of broad kind of geopolitical risk, you know, an election year coming up. So a lot of things have really driven the slowdown in, again, global and domestic M&A activity. I think going into 2024, there was a lot of renewed optimism coming into the year due to the possibility of rate cuts, potentially coming election year as well, which can go on either side. But a lot of that hadn't really panned out. I think going into March, 4 rate cuts were predicted on the year. Now we're, you know, a lot of analysts are saying 2, some are saying no. So Deal volume has been down this year, kind of through Q1 relative to 2023, but deal value has been up, which we'll touch on in a slide or two. So there are deals, not as many deals happening, but some bigger deals are happening, and buyers and investors are willing to pay a premium for these quality companies that have size and scale. You know, I think with economic growth where it is, with inflation higher than target, you know, we'll see what happens with rates. But I think, you know, until rates come down a little bit, you know, we're probably not going to see activity get back to where it was. Again, kind of diving deeper into the lower middle market, which you can define a bunch of different ways. We look at it as kind of 10 million to 500 million in revenue. This is from a data provider some of y'all may be familiar with, GF Data, that provides information on private equity-backed transactions across the U.S. There's about 300 sponsors that report to them. And as you can see, again, peaked as far as number of deals and valuation multiples back in 2021, have since come down to a little more normalized number. But again, that's primarily driven by, you know, the higher cost of capital the last 18 months. That's really pushed valuations down. Seller and buyer expectations as far as valuation, there's been a lag there, and those haven't really matched up over the last 12 to 18 months, which has caused deals to fall apart or not come to the market at all. I think that's, you know, those have become more aligned within the last 3 to 6 months, I think. So that isn't as much of a headwind, but I think, you know, lagging activity from private equity buyers, they have a ton of liquidity on the sidelines and a ton of dry powder, as people called it, really just money waiting to be deployed. And they haven't been able to find a lot of deals. They found, and deals are happening with quality companies, but not the number that were. I think, you know, the conservative, back on the last slide, the conservative underwriting, there's been a real slowdown in M&A related loan volume across, you know, really across the board at all banks. Definitely a slowdown in lending within the commercial real estate space. So that's, you know, that's driven a lot of it. And valuation multiples are showing that as well, as you see there. You can hit the next slide, Christina. This slide, I think, is pretty informative. You know, again, when you look at kind of TEV, that's total enterprise value to EBITDA multiples, they peaked back in 2021. And as you can see, you know, what that first chart tells you up there is deals size from 10 to 25 million, 25 to 50, 50 to 100, and so on. You can see as you get larger in the deal space, obviously you get multiple expansion. You've got size and scale, you've got diversification, so multiples generally get higher. But across the board, you know, the average multiple has dropped over the last 3 years. But with that, the size premium, the larger companies, the deals in that space have widened, really, again, due to liquidity within the private equity and sponsor space and on the strategic side as well. But the spread between kind of that $10 to $100 million company and that 100 to 500 million is almost a turn and a half higher this year than it was last year. So again, I think that's due to a few things, but mainly, you know, it's indicative of the fact that bigger really is viewed as significantly better in a challenging kind of lending environment. So again, you got size and scale, you generally have deeper bench of management, deeper bench of talent on those companies. And a lot less risk, so they're driving a higher premium. So if you have a quality company and a quality asset, and you're either looking to acquire or sell, those deals are still happening at a premium, which I think is kind of evidenced by that. The quality premium down there, above average, what that means is above average companies that have above average, what they're calling above average financials, which is essentially TTM, 10% revenue growth and 10% EBITDA margins. So clients are paying a quality premium for companies that have superior financials, which isn't surprising, but the premium amount is surprising. And really the incidence, the amount of these companies in the market is down, you know, significantly from last year and previous years as well. So I think, you know, the takeaway is really that a lot of this dry powder and capital that needs to be deployed is looking for good deals and is willing to pay a premium. But if you have a business or an asset that maybe has a little hair on it or some risk, it's probably not going to trade at a premium, and maybe not the time to look at an acquisition or look for a sale. Just there's fewer quality deals out there, and everybody's chasing the good ones. A little bit on capital structure. Obviously, you know, senior debt pricing has really surged upwards the last, 18 months, 12, 18 months. And with that, the amount of leverage within the capital stack has really decreased. You can see up there on the top chart in the left-hand corner that senior debt to EBITDA, 3 is kind of where in a normal environment is kind of a rule of thumb. That's dropped down to 2.4 turns senior debt to EBITDA. 4 turns on total debt to EBITDA is kind of somewhat of a starting point rule of thumb. That's dropped down to 3.3. And I think that's, driven by a lot of things, but mainly just higher interest rates and a lot more conservative underwriting. It's harder for banks to get deals across on the credit side. If they have any hair on them, they're being a lot more cautious with deals, and it's harder. Everybody's chasing the same loans because they're not out there. The quantity's not out there. You can see over on the right just the dramatic rise in interest rates over the last 24 months. Sub debt and senior debt's almost, coupon wise equivalently priced right now. When you factor in, payment in kind or other, preferred parts of the sub debt and the expenses, it's a little bit higher. The rate of return is going to be in the 15 to 17%, but on a coupon basis, hasn't been the norm really in the last 10 to 20 years where sub debt and senior debt's priced equivalently. So that's telling in and of itself. But I think the takeaway here, less debt on the books, more equity having to be injected in deals, and more expensive debt across the board. This just shows kind of a little more detail on that point. Over the last 5 years, the amount of equity contribution that's gone into deals and into companies' capital stack has increased from, about 50% up to about 58%. Senior debt, has dropped from 35 to 40% down to around that 30%. And what that means is for investors, if you're looking to acquire or sell, that basically means you got to lower your valuation or lower your return on equity for it to make sense with you injecting more capital from your balance sheet. So it's really, again, kind of goes back to the point of lower valuations on the whole and lower required returns as well. So I think over on the right, what we noted on the first slide too, there's been a shift in structure of deals. A lot of deals have increased the amount of rollover equity that business owners / sellers are putting into the deal, whether that's kind of via seller note or earn out or just straight up roll equity. That amount has shifted and taken a part of the capital stack of equity that the investors are putting in. So it's alleviated a little bit of that, but generally there's less senior debt on deals, again, due to banks being more conservative on deals, interest rates being higher, and higher bids on these larger deals as well. So an increase in rollover equity and an increase in sub debt and less senior debt as well. The last slide I'll touch on, I think it's interesting, again, Christina and I kind of operate in that lower middle market, really in kind of traditional industries. We're generalists, as we say. We don't have an industry specialty, but we focus on kind of what the bank profile is: core business services, manufacturing, distribution, some retail. And what this slide shows is really those 4, along with healthcare services, have driven a ton of the deal volume, over 80% over the last 5 years, with manufacturing really leading the way, accounting for about 40% of the number of deals over the last 5 years. And really the turns on there are telling as well. If you look at healthcare services and technology, which isn't surprising, but they're at 9.3 enterprise value to EBITDA multiple, and then 10.2 on the tech side. But I think, again, depending on what space you're in, again, still, if you're in an active and attractive industry and you provide value in a space that investors and capital providers view as necessary, recurring, you're going to be driving a higher multiple, and you're going to be driving a lot of interest and activity within that space. And this just kind of goes to that point as far as showing the multiples there. Interesting note, unbranded manufacturing more favorable the last 2 years than branded manufacturing, driving about a turn higher on multiples there. So I'll stop there, Robert, and can take any questions and let Christina kick it off after that.
Thank you. I do have a couple. One is, I'm going to combine a few here, is here different definitions of middle market. How do you define middle market firms? And then you noted some sweet spots. I wanted to, there were questions around that 250 to 500 million. I think it was EBITDA was a sweet spot for the multiples. Wanted to pull a little more detail on both of those things. Definition middle market, and then that sweet spot for maybe higher multiples.
Yeah, I guess the definition of middle market varies a lot. We define kind of the lower middle market. You can either define it, I guess, by a lot of different metrics, but by revenue or EBITDA, and kind of where we position it, again, depending on who you look at. But we look at 10 million to 500 million as kind of that lower middle market. I think depending on what service you're looking at, you could look at 100 million to $1 billion is kind of the middle market, $1 billion and above in market cap generally as kind of that higher end. But, I'd say 100 million to $1 billion is kind of traditionally that middle market space as far as market cap goes. And then touching back, Christina, will you go back to that? I think it's slide 8, maybe. The 250 to 500 is actually total enterprise value. So the market cap of your equity plus the market value of your debt less your cash. So it's not actually revenue. So that would be essentially the purchase price in most cases, not always, but that's the purchase price. Once you get to a certain enterprise value, generally 100 million or above, not always, but you've generally got size and scale. Again, you've got a lot of depth and breadth with management. You've kind of institutionalized the business. You're maybe looking at different ways besides organic growth to grow. All those things are going to be reasons that drive generally higher multiples. Ultimately, it always comes back to kind of that stability and predictability in your cash flows, but the more diversified you are, the more institutionalized the business, et cetera, the higher turns of EBITDA you're generally going to drive on your valuation. I think you're muted.
If you had to use your crystal ball for next year, do you think it would be a buyer's market, a seller's market? What are you sensing next year?
For 2025?
Yes.
Well, I think, we've been in a seller's market, from 2021 kind of through, even 2022 to a degree. I'd say, 23 and this year, I don't know what you'd really classify it as. It's a buyer's market, but again, there's still high valuations and high prices being paid. I think ideally, I think it depends on what happens with the Fed a lot and what they do with rates. If rates come down, I think it's going to turn back to more of a seller's market. I think a lot of companies and business owners and baby boomers that have been kind of on the sideline are going to take a second look at going to the market, and a lot of buyers are going to be more willing to pay if rates come down, if rates stay steady, and it seems like that may be the case. I kind of see more of the same, kind of a mix, honestly. It just depends on, again, what kind of company or asset you have. So not a great answer. I don't have a crystal ball, but I see it kind of as being a mix and really driven by what happens with the election, what happens with the Fed, and kind of where the rates go.
Good non-answer. That you really covered every possible angle. I like that.
Yeah.
And then the next question was interest rates. I think we all thought interest rates might come down in Q4. That seems less and less likely every day. Again, crystal ball question, do you see anything next year? Any kind of interest rate reductions next year? What are your thoughts around those interest rates?
Like I said, I think going into the year, there was, depending on what analyst you looked at and what you read, there was 4 rate cuts. expected or predicted starting in March. Now, depending on where you read, there's 2 coming in September. Like you said, I think that changes daily, and the likelihood of that happening changes daily. I think, the strong overall economic growth, inflation being well above target, the Fed just doesn't have any incentive or motivation to lower rates at the moment. So I think, the election will determine a lot, in my opinion. I guess I think over the next 18, 24 months, rates have to come down at some point, but who knows if employment's above average right now. There haven't been the layoffs that people were expecting. So if I had to bet, I would say, I think rates are going to hold steady through this year, and then at some point in 2025, start to come down gradually, but maybe even not like the 4 people we're picking this year.
And then
I think we're in the new normal. I don't think rates are ever, and I think everybody agrees, rates are never going to get back to where they were probably in our lifetime. I think, everybody's getting comfortable with where, and if you look at it on a historical basis, going back 200 years, rates aren't that high. They're where they've been at times. And if you look at trends, they're where they've operated and kind of been over the long term. So it's just kind of people getting used to it, but.
Last question for this section, and then I'll hold. I've got 10 more, but I'm going to hold them, is around the deal stack. In, I think, maybe slide 9 or 10, you mentioned that the deal stack will include senior debt, sub debt. Wondering what those interest rates are looking like right now for senior debt and sub debt in this middle market. What should folks kind of think is a reasonable range?
I may let Brad tag on to this, but I'd say on the senior side, it depends on a lot of things, but 8.5 to, what you're seeing on here, 11.5, depending on quality, depending on terms, depending on AM. Sub debt all in, traditionally you're looking at kind of 15% all in, 12 to 14 coupon, a few on PIK, a few on expenses. So I think 15 to 20 on the sub debt side is more normal all in right now, and kind of that 8 to 12-ish on the senior. I don't know, Brad, anything to piggyback on there?
Honestly, Eric, I'm a little nervous about throwing out rates on a call like this. So
Yeah. I guess, let me preface that with everything is deal specific.
Understood. I tried
risk-based,
folks.
Robert, it's always risk-based, right?
Yes, I tried to lock you down for a rate that we could write down. Understood. No, directionally, that's really helpful, I think, to just understand it as risk escalates for the lender, rates escalate, and certainly it's fact dependent on the deal and the company. So thank you. I'm going to hold my pack of questions. That was awesome. Give us a little taste, and then I'm going to hit you all up rapid fire at the end with the rest of these questions. Thank you so much.
Okay, so Eric did a great job of kind of walking us through recent M&A trends, also explaining, what is influencing cost of capital. So we know that this interest rate environment, we're going to have higher cost of debt, less availability of debt. You're seeing more equity contributions in transactions. And so this is a good segue into a discussion about capital structure. And we would argue that this is probably the most important concept discussion, our most important slide, because this drives everything. More importantly, it's understanding what is the optimal capital structure. I wish I could sit here and tell you what that would look like for your business, but it depends on the industry. And even within industries, companies within industries are going to have different goals and objectives and needs. And so what that optimal mix of debt and equity and everything in between is going to look like is going to be really specific. But we can see how those influences, external, internal, to a business are going to impact what your capital raising abilities are going to be. And so it's important finding your optimal capital structure because you really want that financial flexibility. You want to be able to take advantage of opportunities and investments, growth, expansion. You also want to be able to weather some storms. And so having that flexibility, not having too much debt, but also understanding what is the right mix, which is based on what your goals are. And so here, this is kind of how we take our approach to looking at, a capital structure. And ultimately, you want to increase shareholder value. We know that cost of capital also impacts valuations. We're seeing how that's being impacted. And so ultimately, all about shareholder value, maximizing that. So here, this slide kind of takes an approach of how you would look at, first of all, understanding what your current capital structure is, and then also understanding, what is your capacity to take on different types of capital, senior debt, sub debt. Eric mentioned, that junior debt, mezzanine debt, in the current environment, maybe banks are less willing to lend, maybe they're more risk averse. And so you're going to have to look at other capital sources in your capital stack. And so as you move up, it's more risky, it's more costly. And so when one thing shifts, you can kind of maybe expect other things to shift in lockstep. And so here, this is maybe something that a bank would look at when they're assessing a company and what sort of debt capacity they may have. They might look at it from a cash flow leverage perspective, balance sheet leverage, asset enterprise leverage perspective. And so I think primarily we can start with cash flow leverage, what a bank might look at, what is your capacity for senior debt? And so here, this is just an example, a company right now that has 13 million in total debt with an EBITDA of about 10 million. They have funded debt at 1.26 times EBITDA. Okay, and so when we look at a general rule of thumb, 3 times EBITDA, so 3 times 10, about 30 million debt capacity, less what they currently have. They've got some senior debt capacity of about 17 million. And so maybe this is a good conservative approach of, maybe that's the max amount that a bank is willing to lend. Obviously, depends on other things, creditworthiness of the business, the industry, risk. But maybe you could look at it. So if you're looking at financing an acquisition, maybe you can look at, doing some less costly capital in the form of senior debt. Then when you do another turn, 4 times EBITDA, this is maybe, you don't want to operate at that much leverage, but you've probably maybe maxed out on your amount of senior debt or, financing that you could get from a bank. And so that's when you're going to start looking at other sources of capital, maybe that junior subordinated mezzanine debt. And so when you look at that incremental debt leverage that you have above your senior funded debt, there's an additional 10 million of capacity, for example. And so sources of this junior subordinated debt could come in the form of, types of providers might be some commercial banks, large investment banks, family offices that are responsible for managing high net worth families, and then also private equity, especially when they're doing leverage buyouts. They're maybe going to use a mixture of capital that includes mezzanine subordinated debt. The other perspectives you can look at is just balance sheet leverage. So that's going to look at funded debt to total capital. And you can see the different fluctuations in how you're going to look at what your leverage, your capacity is. These are other things that a bank might also consider as they look at what potentially they would be willing to underwrite or loan. Asset enterprise leverage, this is another perspective. It's helpful in looking from a collateral perspective. So you're going to take all your assets and kind of rank them from most liquid to illiquid. And then what value you can get from that, that's going to be your marginalized asset value. And so when you look at your current total funded debt compared to your marginalized asset value, whatever is remaining, that's your debt capacity. And then you can also look at it from a funded debt to enterprise value. So if you have an enterprise value range, you're going to say about 50% of that enterprise value is what your debt capacity could look like. So all of this is just really helpful perspectives in understanding how you're going to optimize your capital structure. What is the right mix for you based on what your goals and objectives are? Other things that impact, what would be an appropriate capital structure or what your access to certain types of capital would be, stability of cash flows, size and scale, the industry, basically any risks that add or mitigate to the creditworthiness of the business. You would like to use all forms of the cheapest amount of debt, but, you can't be over levered when you're using too much. Senior debt, first of all, you can't get the financing. Also, you have debt service issues, maybe bankruptcy, liquidity concerns. So just a lot of things to think about. We can't emphasize enough quality of earnings. And I think going into our next slide, there are other things that drive shareholder value that don't just have to do with the cost of capital or your capital structure. These are things that you can control. And so I cannot emphasize enough financial reporting, having good quality reports, so getting audited or reviewed statements. Shareholders should also be invested in that because they want to know that the numbers are what they purport to be. And then especially if you're going to prepare for some sort of transaction, having good quality of earnings is really good. It's going to show that there is faith and they have confidence in the numbers are what they purport to be. And then certain types of lending requirements from banks will require more sophisticated financial reporting. The other thing I just want to touch on that drives value is margins. I think becoming overly concerned with just trying to increase and grow revenue, oftentimes, incremental changes to margin can have an outsized impact to shareholder value, more so than just, increasing by the same amount of revenue growth. And then two other things, diversification in all things is super critical, not just in your customer mix, but also your supplier mix. And then staffing, which I think is beyond just recruiting and retention. It's really looking at your succession planning. Do you have the depth and breadth of a management team that can really step in and take a leadership role? And do you have, sort of folks waiting in the back who could also step in? That's really critical, especially if you're looking at some sort of transition in ownership. Again, just more things to emphasize if you're preparing for some sort of exit or a transition in ownership, really having financial preparedness, which is the quality of your earnings, those audited, reviewed financial statements, having a good key management in place, strategic planning of understanding, what's your roadmap of where you want to go, where are you now, what's your future state, and how are you going to get there. And just being organized and preparing for what that is. We can't say enough to multi-generational family-owned businesses is that, in order to preserve as much value in your business as possible, you want to be prepared because you'd like to be able to control the timing of your transition or an exit, but sometimes life has circumstances that are beyond your control. And if you have done the groundwork and the preparation ahead of time, you can really preserve the most value in your business and possibly avoid maybe leaving family members with the additional burden of having to deal with, handling the operations of the business. So a few things, since we're talking about M&A, probably one of the most important, maybe possible headwind that I think should be on everyone's radar is this regulatory risk. Right now, the Federal Trade Commission and the Department of Justice have issued some proposed merger guidelines last year. They don't go into effect. They aren't in effect right now. And we don't really know if they will or there'll be any modifications to the proposed guidance. But what the proposed guidance could do is increase the likelihood that a transaction could be deemed anti-competitive. So it's going to lower that threshold for what could be deemed as an anti-competitive transaction. And so a lot of you all might be familiar with a federal law called Hart-Scott-Rodino. And so when a company is going to make a transaction over a certain amount, it's usually a little over $100 million, they have to make the government aware. They have to make the FTC and the Department of Justice aware. There's a lot of documentation that they have to provide in support of getting this transaction approved. A lot of that is around proving and showing that this transaction would not be detrimental to consumers. It is not anti-competitive. And so what the proposed regulation is looking at is possibly reducing that threshold for what market concentration is. So right now, if it's at a higher level, reducing that just means there's more scrutiny, more deals that could be deemed anti-competitive. They do allow, they're saying in the proposed guidance, for a rebuttal period. All that kind of says to me is that we don't really know what it would take to overcome an assumption that a deal is anti-competitive. But what it does mean is that there's going to be additional documentation that's going to be required, probably additional legal fees. It's going to prolong the close process. So the amount of time it takes to complete a transaction, if these merger guidelines do come into effect, could increase. And the biggest, deal killer is time. And so you want to be efficient, you want to be quick in getting to close. But if you're having to wait for government approval and guidance and provide more documentation, you could expect that you're going to see that time increase to get to close. And so I think that is a nice segue into a discussion about employee stock ownership plans, or ESOPs. If the idea of having to deal with financial reporting with the government, or dealing with an outside investor or private equity maybe turns your stomach, or your owner doesn't really like that idea, an ESOP could be an option. It's a type of exit strategy, a type of liquidity event, a way to raise capital. And so we are not ESOP experts, but we're going to give you kind of a rundown on what is an ESOP, how do you establish one, and what are some of the challenges and benefits of an ESOP. At its heart, what an ESOP is, it's an employee benefit plan. It's a retirement plan. So over time, employees will own shares of the company. And then when they leave or retire, they can cash out. And so the way you establish an ESOP is you create an ESOP trust, and the trust is responsible for holding the shares of the company. So the ESOP trust needs a way to purchase shares. They can either do that with cash. The company can contribute cash to the ESOP trust so that they can purchase shares on behalf of the employees, or the ESOP can borrow money. That's called a leveraged ESOP. And so different, requirements go into being able to establish those too. But essentially, once you have the trust, you have to get a fair market value. How are you going to price the shares? And so that's really important. And then you'll purchase those shares. And then over time, there might be certain vesting requirements for employees. They will receive those shares. And then when they leave or retire, they can cash out, usually in the form of cash when they do leave. So lots of pros, cons, or maybe challenges to consider when thinking about an ESOP. I think probably the most important ones, I want to touch on are, okay, some of the benefits of an ESOP. If you want to maintain control, maintain the culture, maybe a little bit of the legacy of your company, you don't want a third party coming in and changing some of that, an ESOP could be a really beneficial option for you. The other thing is that there are tax advantages with an ESOP. There are some requirements on how you can realize some of those tax advantages, but it can be really beneficial, increase cash flows for the business. It also can instill a sense of ownership with your employees. It's a way to incentivize them. It can help with retention and recruiting. On the flip side, there are some challenges, and some of those have to do with sometimes with some of the benefits that could come from an ESOP. So some of the challenges that I think is, just because you create one doesn't mean people will be invested and buy into the ESOP. I think you really need to look at what does your workforce look like, and are they a workforce that would really buy into the benefits of having an ESOP? So if you've got a really young workforce and you're struggling to get them to contribute to their 401k right now, this might be a hard sell to get them to say, hey, you want to stay with this company, you want to remain here because this is really a benefit to you. And so sometimes maybe you need the right workforce mix instead of trying to influence behaviors by saying, hey, look, we have an ESOP, this is so great for you, why would you ever leave? Another thing to consider is, while it can have some tax advantages, which can increase cash flow, you also could tie up some of your borrowing capacity. You could have some constraints on that, especially if you have a leveraged ESOP. You might not have as much financial flexibility, and so that means you could miss out on opportunities for expansion, investment, other growth. You've got to service your current debt plus the ESOP's debt. And so just something that you want to think about, especially if you have a capital intensive business, that could be a little challenging. And also timing. I think, if you want a quicker exit, establishing an ESOP can take time. It usually happens in tranches. And so there's certain amounts of shares that are purchased over time. And so it's not a quick exit if that is maybe what an owner is interested in. And then some things that are just kind of neutral to think about, back to the tax advantages. Some people think, well, I just want it because I think, I can preserve more cash for myself. You have to also think about, with that fair market valuation, you do miss out on the opportunity to take your business to the market, which means having bidders, strategic buyers, financial buyers bid on your business, and they might be willing to pay a premium. And so when you look at the premium that could have been purchased for your business, that could offset maybe some of the tax advantages. So just a lot of things, they're not quite as straightforward. I know a lot of people will say, I want an ESOP because I just can avoid all these taxes. There's a lot of things, a lot of maintenance costs. They're complex to establish, and so lots of legal fees. And then you have to maintain annual valuations as well. And that's all I got.
That was awesome. I got a stack of questions. I'm going to hit you rapid fire.
Okay.
One is Eric and Christina, you both sort of at some point mentioned planning and preparation, and got some questions around founders are not planners, and how do you get them to plan? Not like while they're about to get divorced or about to die, but in advance. Any thoughts, advice for us CFOs who are planners that have to partner in these middle market situations with a founder who maybe is a shoot, ready, aim kind of person?
I'll kind of start. I think it's changing the mindset from being just reactionary to being proactive. And I think also bringing it back to shareholder value creation and preservation. As an owner, they should care about, because if they are not prepared when the time comes to have a liquidity event, they could have left a lot of money on the table. And I think maybe that speaks that could be a motivation for them.
One of the things that's happened in the past few years for many, some, not all, PPP money, ERC credits. How do you look at that in buying companies? How should we look at spikes of liquidity, profitability? These are non-recurring things, cash balances. How should we as buyers, if I have my buyer hat on, look at acquisition targets that may have had some PPP money or ERC credits?
I think you've got to back it out. I mean, you got to consider it, but I think, like you said, it's non-recurring. You got to normalize those numbers to get a true sense. Hey, what's the business operating under normal conditions without this money? I mean, you can consider it is on their balance sheet, but I think as an ongoing, going concern, you can't really factor it into the valuation. When we're looking at targets, we usually back it out of our income statement if it's, if they've got the income there, and look at the balance sheet on an adjusted basis. So I think you consider it, but I think when you're doing valuation work, you got to normalize it.
What impact will the proposed increase in long-term capital gains tax rates have on deal volume and multiples?
That's a good question. I mean, if this gets passed, it's essentially going to cut business owners' take home in half. I mean, you go from 23% at the highest end to potentially 39 or 40%. So I think, it could, if it gets passed and there's a date set, I think in the short term, it could potentially, drive deal volume up. And I think it could potentially drive valuations up, because business owners are going to demand more to compensate them and hit that retirement number that they've had in mind, but are buyers willing to pay that? That remains to be seen. I'd say generally speaking, it'll drive valuations down, but I think business owners are going to, they're going to need to demand more if they've got a set number that they're basing their retirement off of that they've got to hit. That's essentially done. It's doubled, been cut in half now. So I think in the long term, it'll probably drive valuations down and volume down, but depending on when it happens, the interim could be different.
And I think it's just really important to tag onto their preparedness for that, getting with your CPA and understanding the tax implications. If you need to establish a trust, those have to be done well in advance of a transaction. You can't be doing those late in the game. And so I think that just emphasizes, if there is more uncertainty, more preparedness is needed.
I am convinced.
I think back to your first question, Robert, is one thing quickly. If you can liken succession and exit planning to retirement planning, the earlier you start, the more prepared you are, the better you're going to be positioned for retirement. If you can liken your exit, whether it's to family, management, or a third party, the earlier you start thinking about it, preparing for it, the less taxes, the more proceeds you're generally going to have. So that's how we like to liken it, in a good way for business owners to grasp it.
any additional considerations for international purchases? If you're a mid-market firm, any additional considerations if you might sell or be acquired by an international firm? You know, as we are mid-market CFOs, any tips or thoughts that maybe we don't think about if we're looking to acquire something internationally or to be sold to an international buyer?
Yeah, I think it's a space, to be honest, we don't deal with that much. You know, we're generally doing domestic deals, but we're working with a company right now who's looking at expanding to the Philippines potentially. And I think there's obviously additional costs. There's different additional regulations and rules. You're going to have attorney fees, you know, domestically and abroad. I think there's going to be costs you don't foresee and costs that are unforeseen on a domestic deal that you're going to incur. There's obviously political risk. I mean, depending on where the acquisition is or who's acquiring you. So I think there's obviously additional risk and additional costs that have to be weighed and thoroughly vetted, you know, on the front end before you start incurring those costs. But admittedly, it's a space we don't really do international deals, so probably not the best insight there.
Probably the other thing I would mention is culture fit. I think that would probably be paramount, is understanding, you know, just because you have an offer, if you're being, sought after by, you know, an international firm that's interested, you know, that offer might seem really appealing, but understanding what that culture would look like, would it be a good fit, a good match?
Personal question. On the buy side of some deals, I was part of a really big company with enormous bench strength, just doing my little part. And now as the CFO of mid-market firms, I wonder sometimes when I should be doing my own quality of earnings analysis. I'm being looked to by the sales and the BD and the CEO as like the expert. But at some point, I just don't have the bench strength, the time on my team. Like, when should I bring in an external partner, a CPA firm, or somebody who maybe specializes in quality of earnings? You know, when I need to phone a friend for the QOE, where is there like a line of demarcation, a size, where, hey, don't try to do that part by yourself. Call in some resources for us middle market CFOs.
I think generally size is probably a good barometer. I mean, you know, the larger, the more complex, generally speaking. I think the bandwidth and capacity of the CFO, you know, how much time do you want to spend on this versus actually running the business? What's their background? They may have the full capability to do an internal QOE, but do they have everything built out, the models, the templates? You know, that takes a ton of time. So I think, I don't have a number for you, but I think probably size-wise and kind of the quality of financials obviously matters. Audited financials versus just internal company prepared. I mean, the smaller the deal, generally the less quality the financials, not always, but so it kind of goes inverse there. But I think the size of the deal and just the scope of work increases with the size too, and what you got to look at and think about. So I think, you know, I don't even want to throw a number out there, but the size is how I would think about it to a degree, and the risk associated.
CFO specific question is, we're often very involved in the deal. And I talk to a lot of CFOs post deal because they're reaching out to me to network because they lost their job. And so I think that almost always happens, but my sample size is going to be way smaller than yours. So I wanted to get your input on that. I think that most of the time every time I bought a company, I let the CFO go. I already know how to do that job. And so I just wanted to see what you see in the marketplace. And then one thing I see is I don't see people negotiate like a deal bonus for the work that's being done on the buy and the sales side. And I think there is a lot of work the CFO is doing. So what are you seeing? If a CFO sells a company, what are you seeing post acquisition with their job? And then what do you see as conversations around compensation for the work that's being done? We're paying CPAs, lawyers, investment bankers. Should we be negotiating something for ourselves for all the work we're doing, buying or selling companies?
I will say with, what we're seeing post acquisition with CFO, that role is key management team. They were part of the management meetings with, talking with prospective buyers. And so the, private equity came in and was looking at the CFO as very critical to the transaction, and that they had separate employment agreements and other incentives, some equity incentives, bonus compensation, to make sure that they stayed on and that they were motivated to see the growth of the company. I think when you're looking especially at private equity, they are interested in good companies. They're good because the people are in the right place doing the right work, and they're good, and they don't want to, upset that by any means. And so showing that you really do understand the operations of your business and that you are motivated to stay on and see the success. And, we're seeing a lot of compensation outside of just salary to make sure that those folks stay on and they want to stay on and they feel like they can be part of the growth.
I think unfortunately it depends on the buyer, and the type of acquisition. A private equity group is making a platform deal. It's their first investment in a particular industry. They're going to want that. Generally, they're going to want that CFO on. If they're making an add-on, they've already got that in place. That's overhead they can cut out. And I think it depends on the size of the deal. Strategic is kind of the same thing as that. They're probably, depending on the size, they probably got a management team CFO in place. It's probably not as critical as an initial investment or one in a diverse or different market than what you're in. So I think it depends on kind of the size of the company you work for, of the target and your company, and also the type of buyer.
I've got 10 other M&A questions I'm not going to cover. Sorry, folks. And I've got about 8 ESOP questions. We're going to cover 1 or 2, and I'm going to combine a couple here. ESOP volume seems to be picking up, becoming more popular. Why do you think that that's becoming more popular? Are you seeing that? And then why that versus other options? ESOP versus selling. What are you seeing in the ESOP space with volumes, and why?
I will say, I feel like we're getting more questions about it. Initially we might be brought in on a call to talk about an exit strategy, sale of the business. And then we'll go through all of that. And at the end, they'll be like, but what about ESOPs? And so I think it anecdotally, it just seems like it's more on people's radar. They're thinking about it. I know they were more popular, probably about 30 years ago, but, I think there's more talk of them. I just hope that if there is more talk of them, that people truly understand and they're using reputable ESOP firms. I would say that's kind of my perspective on it. I think more discussion at a type of exit strategy.
That was awesome. We're at time, so I'm going to wrap up. This has been absolutely fantastic. Thank you. I've written down some great tips. Starting now, plan early, don't go alone. You need to have an internal and external team of partners, CPAs. You need your investment bankers, investment brokers. This is putting together a team. And if you don't have a team, Brad, Christina, Eric do this for a living. This is a perfect team. I'm going to share their contact information so you can connect with Brad. Obviously has an amazing horsepower with this team, and continues to have fantastic hair from high school all the way to the present. It's very, very impressive. He's a great guy. Not only a banker, a CFO, former CFO and CPA. Very, very impressive, and a great guy. I'm going to post something on LinkedIn about this. Please give me a like, a comment, and a reshare. And I hope everyone has a wonderful day. Thank you very much.
Thank you, Robert.
Thank you.
Thanks, Robert.